Welcome back to another episode of Palisade Radio. This is your host, Collin. Returning guest to the program today, Jordan Roy-Byrne, editor of The Daily Gold. We had Jordan on just a couple weeks ago, a very popular interview, and I would direct any listeners interested to go back and take a listen to that interview. But today, Jordan, I want to get your thoughts on how the market's progressed in just a short couple of weeks here. How are you today?
Hey, I'm doing well, Collin. Thanks so much for having me again.
For sure. Well, look, let's start with a discussion that we were just having before we started to record, and I brought up the point to you when we're looking at 2016, just because that's the most recent, mini bull market that we had in these gold stocks. It took a couple months. It was I remember January and February kind of went by, and there was not an indiscriminate move in the juniors. That didn't come until I think late in March. And I'm looking now, there are select juniors, obviously, that are performing very, very well. But as a whole, a lot of these stocks are still 52-week lows. I think that when that next move comes, it's going to really get exciting. Have you been noticing a similar thing, and what do you think is going to take to change it?
Well, as far as noticing a similar thing, it's difficult to say because, there is the Toronto Venture Exchange, but that is, you have a whole host of different companies in there. You have, marijuana companies, you have tech companies, and then you have, energy companies and, and you have uranium companies. And, I guess if we're just looking at gold and silver, do we segment those away from uranium? So to look at gold exploration, it's very difficult. There's not like one index where we can really pin down all the companies that are under a 50 million or 30 million market cap. But I do think what you're saying is correct in that we have not gotten that massive re-rating that the entire sector gets. And I think for that to happen, what I've been thinking in recent weeks is that it'll start to happen when we see GDX and GDXJ break the 2016 highs. So we've seen GDX already do that. It's 7-year breakout, massive breakout from a massive base. GDXJ is not quite there yet. It's going to take some more time. But my thinking would be when GDXJ is able to break its 2016 high, that could be a trigger to see basically everything in junior land start to move. And then, another point on that, it could also be, a second component could be when gold breaks 1,800 or maybe even 1,900, or maybe that doesn't have to happen. Maybe it's just when GDXJ is able to break above its 2016 high. So I think, looking at those that haven't moved yet, the time is ripe to really start looking at those, because when when money starts to trickle down and people get optimistic and the momentum is really picking up in the larger parts of the sector, that's when the things at the bottom can really, really move. And you talked about 2016. I would also mention the 2008 example, because in 2008, basically the sector bottomed in late October. Now, if you look at GDXJ, that actually it made like a double bottom, but a slightly lower low in November. So that actually bottomed in November. I'm looking at the parent index on the MVIS website. That's where you could find that. But GDXJ and those juniors, they really didn't start to outperform and lead, until I want to say early December. Now, at the end of December was when silver started to outperform gold, and you started to get, more optimism around, inflation expectations and that sort of thing. But the juniors that you're talking about, I don't think those really started to move until March. So, it was several months before those things really started to move. So I don't know. It could take a few more months for these juniors that haven't moved yet to really start to move. And again, I think the trigger for that is going to be when GDXJ breaks out of that 7-year base and from its 2016 high.
I don't have the chart in front of me, but I don't think we're too far away from that breakout coming, which is quite exciting. I remember kind of the shift in calls I was getting in 2016. At some point, people were calling asking, do you know any companies that are raising money below 5 cents? And it's a funny dynamic where, I mean, you're obviously picking stocks to make money, not to necessarily find the highest quality deals. So it's funny when money really starts to trickle down to the trash of the trash to make the most money.
Yeah, I mean, I've been thinking the same thing, that there's probably not going to be many 5-cent financings out there, when these things happen to the sector. I mean, if there is 5-cent paper out there, it's probably something you don't want to invest in. That's just my opinion. But I mean, your larger point is interesting because it's something I'm thinking about, and it really depends on the person. The question, I guess, right now is, do you want to buy high quality, something that's already moved a lot? It still has really good upside, or do you want to go a little bit lower on quality and something that could have even more upside, have 5x or 10x upside? I mean, that's something that I'm looking at. I'm evaluating the potential of everything I own, and there's still some high quality things which I think can be 10 baggers. And of course, in exploration, when you look at those, it's a bit harder to predict because you can't predict if they're going to make a huge discovery or not, or how valuable it might be. But I mean, that is something that people have to think about and just understand that I think everything still has a lot of upside, but the highest quality things in junior land may not have the most upside right now. And it may be, maybe you have to look at, adjust those dials. And maybe if you go down the dial and you lower the quality somewhat, you could find something that has, 10x potential. But again, you're taking you have to take a little bit more risk to get that type of potential upside. So I don't know what your question was, but that's something that it's something I'm always evaluating in my mind, assessing potential versus quality. I guess it's just something people have to think about as this bull market continues.
Jordan, how cheap are gold stocks versus gold right now and silver stocks versus silver? Because I remember over the last couple of years, several times, people saying not only is gold or silver maybe cheap compared to what it should be, but these stocks are cheap compared to the commodity. Is that still the case today?
It still is based on like a super bird's eye view. And what I mean is, when I wrote my book and updated it, when I first wrote it in 2015, the reality is gold stocks were probably the cheapest they'd been possibly ever, or in, if you want to be exact, it was probably 90 years, maybe 85 years, something like that. And if you look at any index of gold stocks versus the S&P, they kind of made this big double bottom where they had this first low in 2015, and then I think it was in late 2018, they made another low. So that gold stocks relative to the stock market, they're coming off of that massive bottom. And in 2015, Collin, the gold stocks relative to gold were almost just as cheap. I mean, I think they were like similarly, I think they were at a 90-year or 100-year low. So, I mean, we're looking at just going back a couple of years. I mean, gold stocks were probably the cheapest they'd ever been. And I mean, it's going to take years and years and probably decades before they get extremely expensive again. And looking at the silver stocks are kind of difficult because a lot of the silver stocks that are still around, they've gotten into gold to kind of survive. But I mean, I think silver relative to the stock market, silver relative to gold, you go back to 2015. I mean, it was like the cheapest that it's ever been. And the gold stocks in the last 4 or 5 years, they have performed a lot better than silver. So silver right now is probably cheaper than the gold stocks. And again, these things are not as cheap as they were in 2015. But, in 2018, they were damn close to that. And right now, they're still pretty cheap. I mean, if we're looking at historical cheapness as far as what percentile they may be in, they're still somewhere in the 90s, historically speaking. I mean, they were, 100% at that 2015 low and maybe 97, 98% at the 2018 low. But so even though they've moved up, historically speaking, these things are still extremely cheap. And, that doesn't mean they're going to skyrocket, in the next couple months or the next year. I mean, we can't predict that. But more likely than not, what it does mean is that, 10 years from now, 15 years from now, these things have a massive amount of room to move higher, because that's what happened when something it's at a 100-year low. I mean, it's going to trend higher and higher for many years.
Jordan, since we're talking about 10 or 15 years out, it brings up something that I often think about. When you're managing a portfolio, whether it be your own portfolio or a much bigger portfolio, the same question comes to mind. Right now, it's money-making time. I think anything you touch is going to go up. But at a certain point, when you've made 10 times your money or 12 times your money 2 years down the road, what are the telltale signs you're going to be looking for? Not necessarily for this whole gold trade to be over, because you've been very vocal that it could last for 15 or 20 years. But what kind of things are you going to look for to say, maybe it's time to, take some money or quite a bit of money off the table?
Yeah, well, first thing I'll say, when I say 15 or 20 years, like, there will be bear markets during that period. I mean, if you look at the 1957 to 1980 period in the gold stocks, I mean, there were, I think, 2 really bad bear markets in there and maybe 1 or 2 others. So there are, this doesn't mean that you can pick a junior or pick a senior and I'm just going to hold this for 20 years, because these companies change. I mean, they get bought out, they fail. Big companies, they merge, et cetera. They might change what they're doing. So a lot of those things can happen. So I want to make that, really clear, that I'm not saying you could buy something and just, not pay attention for 10 or 15 years. Again, there will be bear markets in there. But I think, you have to look at the fundamentals and real interest rates. Also, I think how the stock market is doing is going to factor in that. We see the economy having a real expansion, and we see the stock market recovering and perhaps outperforming precious metals, then that's something that should get you concerned. But I mean, I want to give a couple examples on this, Collin. If you go back to 2008, for example, the stock market recovered in March 2009. The recession ended, I think, a couple months after that. But if you look at precious metals, they still did well for another 2 years. So they still made huge gains even after the stock market recovered. And the same thing happened. There's 2 more examples of this. The same thing happened in the early 2000s. I mean, the gold stocks, they bottomed at the end of 2000. And you look at the stock market bottomed at the end of 2000. And the gold stocks, I mean, they did really well until the very end of 2003. And then they went sideways for 18 months. And then they had another massive move higher in 2005, 2006. Just because the economy bottoms out and recovers and the stock market recovers, that doesn't mean that you have to sell precious metals. Another example of that, Collin, the 1930s. I mean, the stock market bottomed at the end of 1932. Gold stocks still did really well into 1935. So, I mean, I guess I'm kind of, poking holes in my own answer here, but I mean, the big picture answer is, when the stock market and the economy have a real recovery and they start to outperform precious metals. But even if that happens, Collin, history is telling us when that happens, precious metals can still do really well for a couple more years after that. So I think it's way too soon to worry about having to sell everything, because we're going to have another bear market. I mean, my advice on selling is this. There's a couple different reasons why you should be selling. Number one, if something fundamentally changes with the company. Number two, for me personally, you buy something and it goes down 20 or 30%, and mentally you're cutting your losses at that point. But the other thing, Collin, is when something rises and it does so well, it becomes too big as a percentage of your portfolio. That's when you want to trim your position in that stock. You want to scale out of it. Depending on the company, maybe you think it has 1,000% potential. If it goes up 200%, maybe you sell a third. If it keeps going up, maybe you sell another third, and then you deploy that cash into something that is maybe a better value at that point. So that's how you have to think about selling. It's extremely difficult, but assuming we all make great buys and things are doing really well, you have to scale out of positions on the way up. Sell a third here, sell a third there. Maybe if it's really risky, you sell a half, you let the other half ride. So that's how I would think about selling your positions, more so than just exiting the sector because you're worried about a bear market.
Speaking of the stock market as a whole, I was looking on Friday, and I noted that the stock market was down, say, 2.5%, and on that particular day, the GDX and GDXJ actually did the exact opposite. And one day never really means that much, but I thought it was interesting that happened, because a lot of investors, gold investors, are concerned that the stock market maybe has another leg lower. and they remember that gold stocks crashed very, very badly on that first crash down in the stock market. Does a day like Friday matter in terms of the reaction that gold and gold stocks had to a market decline? I mean, that should allay some fears of investors, no?
I mean, it matters anecdotally because it's only one data point. But I would focus on I look at the GDX to the S&P 500 ratio, and when GDX had its huge breakout a week or 2 weeks ago, whenever it was, the GDX to the S&P ratio was also breaking out in tandem, and that's what we want to see. We want to see precious metals strongly outperforming the stock market, because in the last couple of years, Collin, precious metals were rising. They were doing fairly well, but you didn't really have a real bull market because the stock market was going up. People were buying stocks. Now that the stock market is struggling and you have gold stocks breaking out against the stock market, that tells us that capital is moving away from the stock market and into gold stocks. That's what we want to see. That's what fuels a real bull market. And again, I mean, that's what we're seeing now. It's a good thing. If the S&P has another big leg down, will that impact gold stocks? I mean, maybe, it's possible. I'm not that worried about it. If the S&P rolls over and goes all the way back down to its bottom, maybe GDX will correct 15 or 20%. It's just a guess. I'm not sure, but we'll have to see. The real key with that, Collin, is how GDX performs as far as holding the 7-year breakout. It has that level right around 31. As long as if the stock market is falling and GDX is holding above 31, that's going to be a real signal that it's not going to be that negatively impacted by the stock market rolling over again. And who knows, Collin, if the stock market rolls over again, but we'll probably see even more government intervention, probably more spending packages coming. The Fed's probably going to say we're going to have to start, buying stocks and buying stock ETFs to help the stock market. If all that stuff comes about, then maybe gold, precious metals will react positively on that news and perhaps even rise. So I'm not predicting that. I'm just saying, just keep an open mind about it. There's a lot of evidence in history where gold stocks have done very well, even with the stock market falling. It really could go either way, but I'm not worried about it because gold stocks have broken out against the stock market. And in my opinion, the worst case scenario would be we see a run-of-the-mill correction in gold stocks if that happens.
Fair enough. Well, Jordan, thanks for coming back on the program with us today, sharing your views. We'll definitely get you back on here in the next couple of weeks. And we're recording this on Thursday. The price action is certainly getting very exciting here towards the end of the day, coming to the close.
Yeah, absolutely. I definitely look forward to being back, Collin.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?